So, welcome students. Today we are going to deal with some of the accounting terms related to financial management and cost accounting course. You know, accounting is the language of business and it has its own vocabulary, and it is therefore very important to understand and know what these terms are. So today we will discuss some of the basic accounting terms which are widely applied in accounting. The first is assets. We often speak assets, liabilities. You might have heard assets, liabilities. What is an asset? It is important to understand what is an asset, what are liabilities. So in layman terms, if I say anything which we own is an asset. Suppose I borrowed a pen from Manish. So, though it is with me, but it is borrowed, and I am supposed to return it to Manish, and therefore it is a liability. It is not an asset. But if I have my own pen, then it is an asset for me. So, assets are property or legal rights owned by an individual or business to which value can be attached. Assets have value, and it is a legal rights or property, right, that we own. So anything which enables the firm to get cash or benefit in the future is an asset. For example, a stock of goods, cash, amount, then amount owned, debtors, these are all assets. If we have some goods, we can sell it. So this is an asset for me. Then there are different types of assets. There are fixed assets which are used for long term, like land, building, machineries. Then there are current assets, those assets which are kept for short term with a purpose to convert them in cash or resell, like unsold goods, debtors, bills, receivables, bank balances. So suppose you have a cow. So cow is a fixed asset. It gives her services for a longer period. We can utilize her services for a longer period. And the milk that we receive from the cow is a current asset, sort of. We get it every day and then we sell it every day. So this is the difference between the fixed and current assets. Then tangible assets, you know, those assets which has physical appearance. That is, they can be seen and touched, like machinery, computers, etc. So these are tangible assets. Then there are intangible assets, those assets which have no physical appearance, like goodwill, trademark, patents. All these have values, and therefore these are the assets, but intangible in nature. We can't see them. Then there are wasting assets, those assets which are natural resources consumed during the process of use. So these are the kind of assets which are natural resources and their services are consumed during the process of conversion or use, like mines, quarries. So then what is liabilities? I have already explained. Liabilities is the amount which the business owes to outsiders. So something we own and something we owe to others. So these are the items which we owe to others, outsiders, and that is expecting the proprietors. Proprietor, except proprietor, if we own something to others, that is liabilities. The claims of those which are not owned by the owner are called liabilities. So in accounting equation, liabilities equals to assets minus capital. In business, transactions are recorded assuming business to be an entity distinct from the owner. Thus, capital invested is an internal liability. When we go for a business, we consider business a separate entity and the owner a separate entity. Okay, and the records are maintained accordingly. So thus capital invested is an internal liability because an owner has his claim on the capital invested. Then external liabilities arises due to credit transactions or loan raised As for example, creditors, bank draft, bills payable, outstanding liabilities. These are all external liabilities because it is owed to, we owe it to those outsiders. Then classification of liabilities. Liabilities are also long-term liabilities and current liabilities. Long-term liabilities, which are payable after a long term, usually more than a year. As for example, long-term loan, debentures, etc. And then there are current liabilities, which are payable in the near future, generally within a year. So these are bank overdrafts, bill payable, etc. So we are supposed to pay it within the given period, within a year. Then capital. We have already discussed several times about the capital. Capital is the produced means of production. Capital is that amount which is invested by the owner in the business. So it means the amount of money or the value of assets invested in the business by the proprietor on which he has claim. Once he invests in business, then his motive is, his claim is to get return in lieu of his capital invested. So capital is also known as owner's equity, proprietorship, and net worth. Owner's equity means owner's claim against the asset of the business. So he has invested in the business and he has claims, certain claims against his investment, and that is called owner's equity. That is capital. Then fourth term is expenditure. Expenditure is the amount spent or liability incurred for expenditure. Just understand that expenditure is the amount spent or liability for the benefit received. If we buy something, so in lieu of making payment, we receive a good and it gives us benefit, so it is expenditure. Then capital expenditure, it is also of different types. Capital expenditure is the amount spent on purchasing assets which gives benefit over a number of accounting years. So it is a kind of expenditure which is made for a longer term period, which gives benefits over a years, more than an accounting year. So this is capital expenditure shown on the asset side. It is shown on the asset side of the balance sheet. As for example, purchase of machinery to produce goods. Machinery is a long-term asset. It gives benefits over a longer period, and thus it is a capital expenditure. And second is revenue expenditure. It is a kind of expenditure. It is an amount spent on purchase of goods and services which are consumed during the accounting year itself. So it is consumed in the same year when it is made. It is spent. It is recorded in the debit side of the profit loss account. So capital expenditure is recorded on the credit side and this is in the debit side. Then expense. Expense is the amount spent in order to produce and sell goods and services which generates revenue. So there is a difference between expenditure and expense. Expenditure is the sacrifice or payment made for receiving the value worth the goods that we purchase or buy in lieu of the expenditure. Whereas expense is the amount spent in order to produce and sell goods and services which generates revenue. It is the cost of the use of goods or services for the purpose of generating revenue. That is payment to the salaries, wages, rents. These are all the type of expenses. We pay salary for preparing something, for producing something. We sell salary for marketing. So this is the amount spent on the salaries and wages, and these are expenses. These are the type of expenses. Then income is the profit. Income is the profit earned during a period of time. It is the difference between revenue and expenses or cost. So expenses is nothing. It is the difference between the revenue and the total expenses or cost. Revenue refers to the amount which is added to the capital as a result of operations, sales or goods or services. So this is called revenue. Then there are creditors. Creditors are the person to whom the company owes money in return of the benefit, goods or services provided by them. So company sometimes sells to outsiders on credit or buys something on loan or credit. So creditors are the person to whom the company owes. Company has to pay to the outsiders in return of the benefits provided by them. So they are creditors. Debtors are the person who owe money to the company. So they are supposed to pay to the company in return of the benefits received from the company. And these benefits be in the form of goods, services, cash, etc., which is provided to him by the company. So debtors are the persons who owe money to the company in return of the benefits received by them. Then journal. Journal is the book of first entry. When we receive some goods, so or when we go for any transaction, the first entry is made in the journal. So it is also known as book of the first entry. All the financial transactions of the firm are first recorded in a journal in a date-wise or chronological manner, means as and when it occurs. It also records which account is to be debited and which is to be credited. It records a brief statement regarding the particular transactions. These statements is called narrations. So the statement about the transactions are called narrations, and it also records, it also mentions which account to be debited and which account to be credited. So it contains a comprehensive information and guides while the entries are being transferred or posted in the ledger. Then drawings. Drawings represent the withdrawal of money or money's worth by the proprietor. So when an owner or proprietor withdraws money or money worth for goods from the business, from the capital, it is called drawings for his personal use. When it is for the reinvestment, then it is again the part of capital, but it is for the purpose of personal use, and that is why it is called drawings. Then sales. Selling of goods in the normal course of business is called sales. It may be cash or on credit. Then what is voucher? Voucher, it is an evidence of a business transaction. As for example, cash memo, invoice, bill, receipt, debit, credit notes, these are all the type of vouchers. So it is the record of business transactions. Then receivables, the outstanding amount due from outsiders. It includes all the amounts due from outsiders is called receivable. Means which are supposed to be received by the company, by the organization is receivables, and receivables are from the outsiders. Then payables, which the company is supposed to pay, the amount which is to be paid by the company to the outsiders is called payables. Then book value. This is the amount at which an item appears in the books of accounts. When a transaction is made, goods or services are obtained, the value of those goods are entered in the book of account, and that value is known as book value, at which it was first entered in the books of account. So that is called book value. Then balance sheet. Balance sheet is a statement of the financial position of an individual or enterprise at a given date that covers assets, liabilities, capital, reserves, and other account balance at their respective book values. So balance sheet is simply the statement that shows the financial position of a company. So it gives the financial status of a company at a particular date. Then entity. Entity means an economic unit which performs economic activities. As for example, the owner is an entity, the business itself is an entity. Okay, so proprietor is an entity. It is separate from the business. It is assumed separate from the business. Business itself is an entity because it is different from the owner. So it is an economic unit. It is a unit which performs economic activities. Then proprietors, the persons or the person who makes investment and bears all the risk associated with the business. So proprietor is simply the owner of the business. He makes investment and then he bears all the associated risk in the business.